Hello everyone. Today I am presenting our presentation on the major assignment, the fracking oil investment decision, with my group partners Gurkaran Singh, Vaishali, and me. Now let's get into a little background. A Texas oil prospecting firm with the drilling rights acquired through high interest bonds and aiming to capitalize shale oil seeks wealthy investors. The firm offers shares at 10 million each, representing Wells' income for 8 years. A potential investor requires an analysis of the investment's net present value at 15% discount rate, considering various scenarios. Now here, a spreadsheet is built that models the investment opportunity using distinct sections including constants, inputs, calculations, income and cash flow statement, debt earned, and summary of key results. Then this spreadsheet is used to discuss different investment scenarios and provides an analysis of the decision. Here are our constants calculated through the year 2016 to 2024. Income tax rate, which is fixed at 20%, 1 million cash needed to start each year, a declining rate which varies every year, an initial production rate of 500, and interest on junk bonds of $500,000. Our inputs are price per barrel $50, interest rate on the new debt of 4%, and the required investment of 1 million. These are our calculations. First is the initial production rate, second is the average production / day in the year, third is barrels of oil produced in the year, and this is our final income statement and cash flow statement. This is an analysis of the debt earned, with the beginning of the year debt at 1 million, which is repaid by the end of the year, and then we are net debt free each year. Here is the summary of key results such as net income after taxes, end of the year cash on hand, end of the year debt earned, and net present value of the investments. Now we have built several scenarios according to our investors' decision. Now here, his represents the Texas oil man and yours represents our investor. Now let's see some implications. The choice of scenario significantly impacts the financial health, liquidity, and varying level of indebtedness of a project. Increase in property tax and utility rates have not been able to affect the net income, and construction pace is a critical factor in financial successes. So here is the scenario results created by the scenario manager in Microsoft Excel. As we can see here, two of our scenarios, yours 90 and 110, showed positive outcome. And this is our analysis of the net present value of our investment through the years. This is the analysis of our net present investment in different scenarios in a chart form. So out of all the results, the scenario names his 50, his 70, and his 90, yours 50 and yours 70 are not suitable at all, as they generate a more negative net present value, while his 110 can also be considered as it is under the given range, but yours 90 and yours 110 being the most suitable scenarios. So based on this, we have came up with some recommendations. For first, conducting an in-depth scenario analysis provides a clearer picture of potential outcomes and helps in making informed investment decisions. Engaging in negotiations with the Texas oilman could improve the overall attractiveness of the investment. assessing the option of diversifying the investment portfolio rather than committing a significant sum to a single source to mitigate risk associated with uncertainty of oil prices and drilling success. This is our presentation. Thank you.